Hey guys, Beal here. According to CNBC, 44% of Americans can't cover a $1,000 emergency expense. Even worse, the annual bank rate report shows that 27% of Americans don't have an emergency fund, meaning they're just one unexpected event away from going into debt. Now let me ask you this. Have you ever stopped to think about how much of a difference $50 could make in your life? It doesn't sound like a lot of money, right? But saving that amount monthly could generate a passive income that covers your fixed expenses, leaving you with extra cash to build an emergency fund for unexpected situations. In a world where inflation, political crises, and market shifts shape the future, investing wisely, even small amounts, can be your ticket to a more comfortable life. And before you roll your eyes and think, that's impossible, stick with me. In this video, you'll learn how to do it with 5 simple steps to build your emergency fund. And if you already have one, I'll show you how to take the next step into the world of investing. If you're in your 30s to 50s, you've probably noticed that time is moving way too fast to rely solely on your active income. The old idea of work until 65 and then retire is outdated. The new game is building passive income that lets you live better and sooner. How can you make this work in today's economic landscape? The global economy is still grappling with the lingering effects of a decade of political, pandemic, and climate crises. But as always, where there are challenges, opportunities also emerge. Thanks to accessible platforms, anyone with a smartphone and $50 can start investing in assets that were once reserved for major players in the financial market. For example, ETFs, exchange-traded funds, allow you to buy small fractions of giant companies like Apple, Tesla, or Amazon. The best part? The management fees on these platforms have never been lower, enabling small investors to keep more of their profits. But what about the risk? Here's the irony of the market. Many people believe that investing in assets like stocks or cryptocurrencies is like playing roulette. The truth, the greatest risk of all is doing nothing. Leaving your money idle in a bank account with returns below inflation is a guaranteed way to lose purchasing power. As Warren Buffett famously said, risk comes from not knowing what you're doing. So the first thing you need to do is identify your investor profile. Investing isn't just about putting money into something and waiting for it to grow. Before making any move, it's essential to understand who you are as an investor. This means identifying your profile and aligning your strategies with your expectations and risk tolerance. And believe me, this step is simpler than it seems. Investors generally fall into 3 main profiles: conservative, moderate, or aggressive. If you prioritize safety above all else and can't bear the thought of your money fluctuating, you're probably a conservative investor. Applying to high-yield savings accounts, which offer predictable returns with virtually no risk, would be a good option for someone starting out and afraid of the market. If you started investing $50 a month in 5 years, you could accumulate $3,200 over time. Moderate. If you're willing to take some risk in exchange for higher returns but still seek some security, your profile is moderate. Investing in ETFs like the SPDR S&P 500 ETF, which tracks the performance of the 500 largest U.S. companies, or real estate investment trusts, REITs, which offer consistent dividends, will be a good option for you. Aggressive. If you're not intimidated by short-term fluctuations and are focused on high long-term gains, you're an aggressive investor. You can invest in stocks of emerging companies listed on the NASDAQ, crowdfunding startups through platforms like Seed Invest, or even Bitcoin and other cryptocurrencies via reliable exchanges. How to identify your profile? Answering a few simple questions can help. How much risk am I willing to take? What's my goal with this investment? Do I need liquidity, or can I wait years for the results? And don't worry if your answers change over time. The financial market isn't static, and your strategy can evolve along with you. Step 2. Choose the ideal platform. Choosing the right platform to invest isn't just about convenience, it's a decision that can directly impact your results. In the United States, the financial market offers a wide range of options for investors, from simplified platforms for beginners to robust tools for those seeking more control. What should you look for when choosing a platform? Fees. Avoid platforms with high fees, especially if you're starting with small amounts. Security. Make sure the platform is regulated by the Securities and Exchange Commission, SEC, and provides insurance protection for your investments. Accessibility. For those with limited initial capital, platforms that allow you to invest in fractional shares or with low minimum deposits are essential. I suggest using Robinhood, which is ideal for beginner investors. Its simple interface allows you to buy stocks, ETFs, and even fractional shares with just a few clicks. Plus, there are no commission fees for basic transactions. Don't choose popular platforms without verifying whether they meet your specific needs. Some platforms charge maintenance or withdrawal fees, which can eat into your earnings over time. Step 3. Start small but stay consistent. The truth is, small amounts invested regularly can produce impressive results over time. This is the power of consistency. With just $50 a month, you can build a solid foundation and achieve your financial goals. Albert Einstein called compound interest the eighth wonder of the world, and he wasn't wrong. The concept is simple. By reinvesting your returns, you create a financial snowball where your money grows exponentially over time. If you invest $50 a month in a fund, earning 8% annually, you'll have around $9,114 after 10 years. And in 20 years, that figure grows to $28,683. And here's the kicker. You only contributed $12,050, but earned $16,633 effortlessly just from returns. Do you see the power of compound interest now? Small investments made consistently might seem slow at first, but the impact grows exponentially over time. Michael Jordan didn't start out as the best player in the world. He practiced every day. In the same way, investing consistently, even in small amounts, is the path to financial freedom. Step 4. Diversify to protect your money. Investing is like building a house. You need several solid foundations to ensure it can withstand the elements. In the financial world, this is called diversification. Putting all your money into a single asset is risky, even for experienced investors. Diversification not only protects your capital from significant losses, but also increases your chances of achieving consistent gains over time. Diversifying means distributing your investments across different asset classes. This can include stocks, real estate investment trusts, REITs, ETFs, treasury bonds, and even cryptocurrencies. Each asset class behaves differently under changing market conditions. When the stock market is down, treasury bonds typically remain stable. Stocks may continue generating dividends even during periods of volatility in REITs. An example of this happened during the 2020 pandemic. Many REITs struggled, but technology stocks like Amazon and Zoom soared, balancing the impact for diversified investors. While REITs provide steady income, technology stocks offer exponential growth. A diversified portfolio is less susceptible to significant swings, helping investors stay calm during crises. But diversification doesn't mean investing in dozens of assets. Start with 3 to 5 options across different categories and adjust your portfolio as you gain more experience. Step 5. Reinvest your profits to accelerate gains. If there's one secret to accelerating the growth of your investments and reaching your goal, it's reinvesting your profits. Most major investors, including Warren Buffett, follow this practice as an unbreakable rule. Reinvesting means taking the returns generated by your assets, whether dividends, interest, or capital gains, and putting them back into the market. This simple but powerful strategy turns small gains into substantial wealth over time. The power of reinvestment lies in its ability to leverage compound interest. Every reinvested dollar starts generating additional profits, creating an exponential growth cycle. Imagine investing $50 per month in an ETF that pays 4% annually in dividends. Instead of withdrawing the dividends, you reinvest them in the same ETF. After 10 years, those reinvested earnings could add thousands of dollars to your total portfolio value. How to reinvest in the U.S. market. Dividend reinvestment plans, DRIPs. Many ETFs and stocks offer automatic dividend reinvestment programs. With DRIPs, dividends are used to purchase more shares of the same company or fund at no additional cost. Reinvesting in different asset classes. You can use the profits from one asset to diversify your portfolio. For example, reinvesting REIT dividends into tech stocks or ETFs. Automated platforms. Tools like Robinhood, Fidelity, and Wealthfront allow you to set up automatic reinvestments. This eliminates manual effort and ensures your money keeps working for you. It's tempting to use your initial returns to pay bills or buy something you want, but doing so disrupts the growth cycle. Think of reinvestment as a payment for your future. Create a personal rule. Only start spending your returns once they reach 50% of your passive income goal. Imagine Beatrice, who began investing $50 monthly in REITs and dividend ETFs. After 10 years of reinvesting her returns, her passive income grew to $800 per month. This was enough to cover her fixed expenses while still allowing her to reinvest for further growth. With Donald Trump assuming the presidency in 2025, the United States will likely promote investments in strategic sectors like green technology and artificial intelligence. Laws supporting clean energy, such as the Inflation Reduction Act, are offering tax benefits for companies in this sector. This creates opportunities to invest in stocks and ETFs focused on sustainability. Investing in ETFs like the iShares Global Clean Energy ETF exposes you to leading companies in the renewable energy sector, which is expected to grow significantly in the coming years. Additionally, artificial intelligence, automation, and the healthcare sector are continuing to expand, especially after the rise in digitalization and demand for medical innovations. Companies like Nvidia, Microsoft, and biotech startups are leading this charge. If you had invested in Nvidia through Robinhood in 2023, your stock value would have increased by 60%. Another powerful option is the often controversial world of cryptocurrencies. While the cryptocurrency market has faced volatility in recent years, 2025 brings greater regulation and institutional acceptance. Bitcoin and Ethereum remain the leaders, but stablecoins and blockchain projects with real utility are gaining traction. Time is the greatest ally of any investor. The sooner you start, the greater the impact of compound interest, and the faster you'll reach your goals. As Warren Buffett famously said, "Don't wait to buy stocks. Buy stocks and wait." 2025 is full of opportunities, especially with Donald Trump's presidency, but a major recession could be on the horizon. In the video currently on the screen, we explore how Warren Buffett is preparing to make massive gains and capitalize on the 2025 recession. Subscribe to the channel if this video helped you. Good investments.